Good afternoon and welcome to FBN Charting Points. My name is Brian Como. Today is December the 12th. We only have a few of these left before Christmas. All right, let's get into the legal stuff that we have to talk about. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. The material is provided as is and for informational purposes only. It is not intended to be a substitute for specific financial, trading, legal, or tax advice. Neither Farmers Business Network nor any of its affiliates make any representations or warranties, express or implied, as to the accuracy or completeness of the statements or any information contained in the material, and any liability is therefore expressly disclaimed. Past results are not necessarily indicative of future results. All right, I'm not going to go through an entire rehash of the USDA report. I just wanted to touch on a couple of key things, particularly here in the soybean market. Here is the new chart with the new numbers from Brazil in here. So a couple of things that were not necessarily expected in the market. One was a print of 161 million tons for the 2023 crop. That was a million tons more than average trade guesses, which were at 160. That did come down from 163. I think the real surprise, though, is this 160 number for the 2022 crop. So that grew from 158 to 160. What I find interesting about this chart now is that really in order to start saying that this year's crop is smaller than last year's crop, it only takes another million tons of losses. Previously, before the last USDA report, it was 5 million tons, right? We need a 5 million ton reduction would have meant that we are now below that of the previous USDA. Now that has moved to 3 million tons, right? So we have a bigger crop last year, and the crop from this year is not pegged to be as small as what was originally thought. So that does change things a little bit just because of how big that 2022 crop is. I know there is still some speculation that crop might even be bigger than 160 million tons. So that could continue to put a weight on the market if those changes continue to come through for Brazil. This is also what that looks like now that we have everything worked into the mix. Global production of soybeans is set to be record high this year at 398.9 million tons. That's a significant change year over year from up from last year. So we're not in a situation where we are globally short of soybeans in any, from a global standpoint. So I think that there could still be pressure in this market, even if we do continue to see some losses in Brazil, just based on how large this crop is overall in the world. So just to keep that in mind. Here's what the chart of January soybeans looks like today. After the end of today, we did see some reduction here, but it has been a pretty decent rally. We did move above the 20 and the 100-day moving average here today after testing yesterday. If you're undersold on soybeans, this would be a good place to catch up. I think that we've reward the rally here. It did come up and tested and failed some technical resistance. That may be important. I mean, it did find some support today at the 20-day moving or the 200-day moving average, as well as previous lows. So, this is more of a neutral market at this point, and it might just trade with some high volatility in a more neutral stance. But if you don't want to leave too much risk on the table and you are undersold and you're looking for a place for the soybeans to happen, this little rally that we've seen the last few days might be a good one to take advantage of. Just looking at some of the products here as well, because there is some changes happening to the profitability of soybeans and things like that happening because of the products. We saw a little bit of a rally in meal, but not enough really. We have seen a bit more strength in oil over the last little while. But all products have been kind of rising in slowly. So the crush margin for soybeans has been growing, but also the share of the oil inside of the crush margin has been growing. So it's up from 36% in the middle of November to 38% now. Not that comes anywhere near the 40 plus that we saw through the summertime, but it does mean that soybeans are becoming or are getting a little bit more sensitivity to the vegetable oil complex. I think the reason that it's important that we look at the vegetable oil complex is because there has been some significant ties to from the vegetable oil complex to the crude oil market. Here's what today's crude oil market looked like at the time of the snapshot that we took here at about 2 o'clock p.m. Central Time. NYMEX West Texas Intermediate was trading down to 68, 70, 74, 75. It did break to a new low. As you can see, this crude oil chart looks very bearish. We are seeing a series of lower highs and lower lows in a channel moving downward. So if we continue to see these energy markets correct and move lower, I think it does put some of the vegetable oils at risk. And that might have an effect on not only on soybeans if there is more of the crush margin coming from oil, but also from some other commodities like canola, through the vegetable oil complex as well. Here's what the Bursa Malaysia palm oil contract looks like. So again, since the middle of November, it's been in decline. It didn't make a new low or anything today, but we still are kind of seeing a declining market here that has been making some new lows in the month of December. So I think that this market is tied to energy. I think that we need to watch energy as we go forward because it will have an impact on the vegetable oil complex, which will affect our canola. Here's what canola looks like today. Just to kind of recap, the last time we made a recommendation was in this middle of November period here. It's fallen off now. It looks like there's quite a bit of headwinds now to get it back even up into that level. We've got previous lows acting as resistance. We've got the 20-day moving average acting as resistance. We've got even the 50-day moving average here that has to clear before that. So again, there is some risk in this chart. I think it definitely looks like the path of least resistance right now, and this is down. And when you factor in the weakness that we're seeing in vegetable oils and the energy complex, canola could be in for some continued risk as we move towards the Christmas break. Rapeseed in Europe is flat, however, and it's kind of been trending higher from October through a very kind of gradual or even neutral kind of move here in this commodity. In fact, if you were to kind of draw a pennant in between these tops, it definitely looks like a converging pennant here, and the moving averages have been converging as well. So there really isn't any signals coming from rapeseed, unfortunately. So I think looking at soybean oil and the energy complex is probably more important for us as Canadian canola growers at this point. All right, moving on to wheat. Wheat has been a roller coaster of a few days. Coming out of November and into the first 10 days of December, we saw significant gains as China was buying U.S. wheat. They bought more than 1 million tons of it in the last couple of weeks. Yesterday, we saw a really big sell down in wheat after those sales kind of cleared the hurdles. It's kind of rallied back again today, recovering most of the gains, particularly in soft red winter wheat. Really hard to read this chart at this point. Getting more coverage done in times when it gets up to here is probably important now as we kind of moved. While it was trading in this range between 640, 650, you could start to make a case for the 660 area and that kind of thing before a next sale. Now, if it gets back into that 640, 650 area, you might want to be adding coverage into there. So you might start seeing some selling pressure as it gets back up to there now as well after the correction that we saw yesterday. Here's the hard red winter wheat. Very similar, pattern, obviously. Here's the gains that we're seeing because of China and the big steep sell-off yesterday that did break below some technical support, like the 20-day moving average. Again, it recovered most of those losses. So unfortunately, this couple of days of trade will haunt us from a technical perspective. We'll have to see where it goes from here. It's not giving us a whole lot of clear signals. Here's the Minneapolis wheat again, very similar pattern, right? The rise, the fall, and the rebound today. Our last recommendation was made right in here on the spring wheat or the Canadian wheat, with our next kind of target up near here, the $8 range. As you can see, there's a number of different areas for clearing here. So if we do get a correction, or we continue to see some weakness, we may adjust that $8 futures lower as we move through the market if it starts to look too lofty. At that time, it looked possible because we were selling on the upswing. It was getting close to some of these resistance levels as well, and there was some good momentum in the wheat market as a whole. So that wasn't out to lunch on the day that we made the recommendation, but we may be looking at dialing that back at some point in time. Just to kind of reiterate here, this is my last slide. It's a quick technical update today. This is the positions for wheat managed money as we come out of last Tuesday. So as of today, these numbers are officially a week old. We'll get an update on these numbers on Friday after the close. But you can see that all of these wheat markets are still sold quite short. In fact, hard red spring is still in extremely record short position. Hard red winter is kind of climbing out of it, and soft red winter is climbing out of it as well. As you can see, there was some periods of time during 2017 when it was sold shorter. But we still are working with a market that is positioned very short. So far, they've been right about that position. They've been taking profits on that position. I think some of the what we would call short covering, it indeed was covering short positions, but I think there were some profit taking. We might see some of that profit taking continue as we move through the rest of this calendar year, through the last couple of weeks. A lot of bonuses are derived from the end of the year profits, and if there are profits to be taken in some of these positions by traders who are looking to get bonused on their year-end positioning or their year-end profits, this would be a good time to take some profits on these wheat trades. So we might see some of that continue as we move through this calendar year. Full-scale gains on short covering is not a guarantee, but that might be a piece of the puzzle that we could be waiting for here. So that's all we had for you today. Thank you for joining us. We will see you again on Thursday. Have a great day.